Let me start by introducing Neel Kashkari, who's the president and CEO of Minneapolis Federal Reserve Bank, which represents the 9th District. He's got kind of an interesting history for a Fed president. Oftentimes they're academic economists, but he's had a sort of varied path. He started off with a bachelor's and a master's degree in mechanical engineering from a school I refuse to name at the moment. It's a Big Ten school. It might have hurt my alma mater, Madison, so I will not be mentioning the school. Illinois, he did it. That's rude. And then went on to get eventually an MBA as well, so he got his financial chops there. He's spent time at some big names, Goldman Sachs, PIMCO, but he's also spent time in public service as he is now. So I think, it was Veterans Day on Monday. One of the things I think is most impressive about his record is that he was in the middle of the financial crisis. He was working at the Treasury and in charge of TARP. For those bankers in the audience, you know what TARP is. But really, absolutely sort of the worst possible economic times for someone in the business economic world. He was there, and I think one of the people responsible for making the Great Recession only a recession and not the Great Depression. So I think that is really impressive. So I want to just move on right away. We've got some polling questions that we're going to ask you to do here early on, and then I'll ask a few questions, and then the audience will have an opportunity. So be thinking about some questions that you can ask, because if you don't have any questions, we're going to sit up here as two sort of geriatric fathers. I think you have less than a 1-year-old, and so we're just going to complain about our kids and the sleep we don't get. So if you don't ask any good economic questions. So let's see that slide on how to do this. So many of you that have been here for the economic indicators before have experienced this. So if you all pull out your cell phones now, students, I know you've got them, pull them out. You're always sort of sending text during class, so I know you can do this. The first thing to do is to send, as the instructions say, send a text to the number 22333, and you text the word, and this is hard because it's a long word, but it's Minneapolis. Doesn't matter if it's uppercase or lowercase. If you're questioning the spelling, it's up there for you. Text the word Minneapolis, and you hit send, and then you're going to get a reply message. And if you just stay in that text mode, you will see questions come your way that Neel is going to lead us in. So why don't you take a second to text Minneapolis to the number 22333. And then like when I'm looking at the students and they're looking down at their laps, I know that they're texting, so I'm waiting for them all to look up, and then they'll have stopped texting, and they'll be. Then I'll turn it over to Neel.
Okay, well, while you all are finishing that, thank you. Thanks, TJ. Yeah. Thanks for having me. Thanks, all of you, for being here. So let me start by telling you why I'm here, and then we'll get to the poll questions. So the Federal Reserve is our nation's central bank. Our job is to try to manage the ups and downs of the U.S. economy so we have sustainable, steady growth, more or less. And we'll talk about our specific mandates. We call it our dual mandate of stable prices and maximum employment. We'll talk about that more a little bit later. But one thing that's unique about our central bank is that Congress designed it to be divided up all around the country. So there are 12 independent Federal Reserve banks, the 9th of which is the Minneapolis Fed. And our region is Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin. So a big part of my job and my colleagues is to travel around our region and get to know what's happening in the local economy. And then I go back to Washington, D.C. every 6 weeks for Federal Open Market Committee, FOMC meetings that get a lot of attention. And my job at those meetings, in part, is to talk about what's happening in the regional economy. So town halls like this are really great for me to get a chance to hear directly from all of you. The things that I'm very interested in is how is the local economy going here in La Crosse? How are businesses doing? There are many different sectors of the economy represented here. There's going to be some differences, some sectors doing better than others. I'd love to hear about that. Love to hear how workers are doing, what's happening to wages, what are the job prospects for students. All of this kind of information will make me smarter. So when I go back to Washington, D.C., I can then talk about this at the FOMC meeting. So thank you for being here. And the more direct you are in the Q&A session, and it may not be a question, it may be a statement that you might make to me, which is fine, the more I'm going to learn. So I appreciate you all being here, and I appreciate the great turnout, especially from so many students in the back half of the room. So why don't we turn to the questions. First question, how much do you know about the Federal Reserve System and the Minneapolis Fed? Nothing, very little, some, or a lot. And we'll show you the results. I just want to get a sense of where you all are.
This is the part I loved in class when I would do this. I felt like you needed dialing music, though, right?
Okay, so we're kind of clustered around very little to some, just a few people knowing a lot, a bunch of people knowing nothing. This is not surprising. You know, the central bank is kind of a mysterious thing for most Americans. They don't know a lot about it. I think all of my colleagues and I are trying to get out a lot more, talk about who we are, what we're doing, what we look at, just so the public is more informed. Why don't we go to the next one? How would you describe the current job market in La Crosse? Very weak to very strong. Okay, looks like we got a cluster around neutral to somewhat strong. Very few people are saying very strong. Very few people are saying very weak. So this is, I would say, consistent with my view of the labor market in America. The national unemployment rate has fallen from a peak of 10% in 2009 to around 3.6%. That one would expect at a 3.6% unemployment rate that is a gangbusters job market. And yet, we're seeing more and more people taking jobs, people coming in off the sidelines. I think that headline unemployment rate of 3.6% is misleading. I don't think the job market is as strong as that number would indicate, and we'll talk more about why that is. So I think this is consistent with what I would have expected to hear from you. Let's go to the next one. How would you describe recent wage growth at your company or organization? Weak, A is weak, strong, don't know. All right, while these numbers are coming in, so we're seeing obviously a clustering around average. This is another key indicator for us. So businesses, and I imagine some in this room, businesses around the country are going on and on and on about how they can't find workers. It's impossible. Historic worker shortage. Well, if there was a historic worker shortage, you would expect businesses to have to pay up to find workers and to keep workers. Yet if you look at the national wage growth measurements, wages have climbed a little bit, but they're not accelerating. They're not off the charts. They're pretty modest. So I've been saying now for basically 3 years, when businesses go on and on about how they can't find workers, but they're not paying more, I have a word for that. It's called whining, okay? If they really are serious, they will pay more and it'll show up in the statistics. Let's go to the next question. What's your outlook for the La Crosse regional economy, from very optimistic to very pessimistic? Okay, we're seeing a clustering around somewhat optimistic, some people somewhat neutral. This, again, I think is consistent with what we're seeing nationally, where on one hand, the U.S. economy is 70% consumption. That's just individuals and people spending money on themselves and their families, going to Walmart or buying food or buying clothes. 30% is other stuff. Most people who want to work have jobs, and wages are slowly climbing. So the consumption part of our economy is doing pretty well overall. That's the good news. The more pessimistic news is that businesses seem to have pulled back somewhat in the latter half of the year, and they're investing less because they seem to be nervous about the future. So I guess my own outlook for the economy is one of continued growth, but somewhat cautious growth going forward, because there are some risks on the horizon, which I'm sure that we're going to talk about. Again, I think that is consistent with what you all are expressing here in the La Crosse region. Our region generally, this part of the country, kind of represents the U.S. In terms of the sectors of our economy. So we've got a lot of ag, we have exporters, we've got healthcare, we've got services. It's actually overall a reasonably diverse region of the country. Some sectors are doing better than others, and I think this somewhat optimistic view is kind of consistent with what I'm seeing in the broader region and what we're seeing across the country. Okay, for students, what's your biggest concern after you graduate? Job prospects, education debt, wages, living where you want. Well, this is interesting. So job prospects being number one, education debt gets a ton of press coverage nationally. If you add up the total dollars of education debt, it's a lot. But if you actually drill down into the average student or the median student, it's actually much more manageable. There are some students who've got huge amounts of debt, but for most individual students, it's a more manageable level. And then wages, and then being able to live where I want. And so, again, that's interesting that we are allegedly in this historically strong job market, and yet job prospects is the number one concern among students. And I kind of get it. I mean, I remember what it was like being a student. Is that it? One more. Okay, so this is a kind of a word cloud. 1 to 2 words. What's the biggest challenge facing the La Crosse economy or the La Crosse region? Open to anybody. So I haven't heard roads elsewhere. Wages come up a lot, housing comes up a lot, but I didn't know roads were a big problem here.
Terrible.
So it's pretty mixed. So when I travel around our region, I hear a lot about housing costs is a big challenge for folks. You know, I always ask the question, if people have jobs, why aren't developers stepping in to go build more houses or build more apartment buildings? You know, you hear employers say we can't find workers, and yet wages aren't growing very quickly, as we talked about, so that's an interesting tension there. I don't know if you want to tell me about what's going on in the roads when we have our conversation.
I'm a cyclist. I can tell you every pothole is in town.
Okay, good. Well, hey, I appreciate you entertaining that and offering your thoughts. It's a great way we just started doing to set up our conversation. And so let me turn it over to you, TJ, and you can lead us in that discussion.
So I want to, before you walked in, they were talking about a survey they did of business executives, and I guess you would say that they were whining. I too, as an economist, hear this all the time, and my response is not quite as good as yours, but I say it doesn't make sense, right? So, but then they always sort of reply back that there's particular skills that they're looking for. So, you know, what is sort of your view on that? Is it the skill set that's missing? I mean, is it really just they need to pay more and then train people? What's sort of your sort of more longer answer to that question, I guess?
Well, I think as the job market is clearly tighter than it was 5 years ago. And as the job market has gotten tighter, businesses are having to do extra things to find the workers they want. In some cases, they're training workers themselves. You know, 5 or 10 years ago, businesses were used to saying, this is who I'm looking for, this is the experience I want, these are the skills I want, and they'd have people lining up down the street, and they wouldn't have to work very hard. Well, now they're saying, well, I can't do that anymore. I'm going to have to train you how to use this machine, as an example. Or, you know what, I don't need to have a college degree minimum for this job. I can lower it because I don't actually need it. Or in some cases, businesses are saying, I don't need to do the background check for certain jobs, or I don't need to do the drug screen for certain jobs. Businesses are having to go a lot further to try to get the people they want and invest in them and get the skills that they want. So that's kind of a short-term perspective. Longer-term perspective, I really do think it's about wages. I'll give you an example. For years, businesses say, oh my gosh, we just cannot find welders. We cannot find trained welders. And look at what welders make. It's crazy. There's something broken. So I go and I travel around and I meet with community college leaders, and I will say to them the same thing. Why don't you train more welders? All these businesses say they can't find welders. And some community colleges have said to me, we've tried. We expanded our welding program, and we didn't get any more students. Well, that tells me the wages for welders need to go up. And if the wages for welders go up, then more people will say, you know what, I want to go into that welding program and get that skill. So my message to the business community about welders is there is no welding shortage. The United States of America has exactly the right number of welders. And if you actually need more welders, you'll pay more, and then more people will go into welding.
So is it, so I've shown that data too. We had the governor here on stage a few years ago, and he said that same thing. And my response was that wages are high for those industries, but also the probability of losing a job is higher. So is it the wages, or is it also sort of the long-term forecast of the viability of that profession?
Well, I think, and that's fair, but that would just suggest that the wages need to go even more to compensate for that, right? One of the examples that I offer to businesses, they say, well, we tried to pay more, we just couldn't attract workers. If you look at North Dakota in the oil boom, wages went through the roof, and workers from all across the country moved to North Dakota to get those jobs, whether they were truck drivers or they were welders, whatever their job was, because the wages were attractive enough. People respond to incentives, and they're not going to move across the state or across the country for $1 an hour more. They will move for a substantially better opportunity. And I don't think we have a welder shortage in America. You know, one community banker was telling me the same thing. Oh my gosh, welders make $75,000 a year. We've got this big problem, no welders. And I say, how much do your bank tellers make? And I don't remember what she said. They made half that. I said, so why don't your bank tellers quit your job, go to school and become welders and make twice as much money? And she said, oh my gosh, no, they would never do that. Welding is a much tougher job. Okay, well, you know what? Tougher jobs need to get paid more.
Fair enough. I'm going to ask one more question, and then I want to turn it over to the audience. So I just got back from APAM, so the Association of Public Policy Analysts and Management. And the big focus there, I went to a pre-workshop on machine learning and that. And so I want to sort of ask your perception. I mean, you guys at the Fed do a lot of regulation or regulatory work. And I know financial industries are moving more heavily into machine learning and AI. And we know that those algorithms sometimes have bias, right? So the underlying data might be biased that they're training these algorithms on. So how are you guys at the Fed thinking about how you might evaluate that? Because it's, you know, what they've demonstrated now is that the solution of sort of leaving race out of the equation actually is just as biased as sort of anything else because of the way the algorithms work.
I think we are learning and paying attention. I've read many of the same studies that you're referencing to try to understand this. You know, if you, just to elaborate a little bit on your question, if historically, let's just say, give you an example, you had a loan officer making a credit decision, and whether he or her knew it, there may have been looking at the applications through a racial lens, through their own experiences, and that would introduce bias into that process. The hope would be, well, if you have a computer do it, the computer would be not unbiased. But now some research is suggesting that those same biases can be woven into the learning that the computer does. So I don't know if it's worse. I think the research would suggest it's not where it needs to be, but it may yet still be an improvement. So I think this is an ongoing topic of examination and study, and we all, you know, need to learn and keep adjusting our ways because of it.
Okay. We have a question?
So I am an economic development director for Fillmore County over in the western edge here, and one of the, you mentioned the wages. We've seen employers consistently increasing wages, and I think the other side of that, though, is the cost of employment, whether that's the cost of childcare, the cost of housing, and how people can get into the economy. Because the labor force participation rate hasn't changed that. It's about a 5% window over the last 35 years. It's a low relative to the last 20 years, but it's not that low overall. So what about that? What about the cost of employment, and what does the Fed have to say on how that impacts people's decisions on an employment basis?
No, I think those are all right. I mean, one of the things that's happened over 30 or 40 years, generally speaking, labor force participation, the number of people who are in the job market in America has gradually been declining. Now, partly it's declining because we're getting older as a society and we're having fewer kids. And that's to be expected. People get older, they cannot work as long, they retire, et cetera. But even if you look at prime age workers, which is considered to be 25 to 55 roughly, that's also been declining, though now it's recovered somewhat back to around 2007 levels. But we're not back to where we were in 2000 levels, back in 2000, 2001. So that suggests to me that there's still room to grow. But there are a lot of different factors that could be contributing to it. So there could be some of the issues you talked about. Availability of affordable child care is one. We talked about it this morning. I had a roundtable meeting with some experts here. That's one. It's also complicated with incarceration. You know, people who have felony convictions may not be able to get back in the workforce, or people who have dependence issues, alcohol or drug issues, et cetera. There are lots of different reasons why people might be out of the labor market. But one of the things we've seen over the past few years, as the job market has gotten tighter, we have started to whittle away at that and started to slowly bring people back in. And this is resoundingly good news for the country. The more people we can bring back into the labor force, gainfully employed, providing for themselves, contributing to society, you know, we're all way better off. So my broader hope is that we can allow this to continue to run and bring more and more people back in, because it's good news for all of us. Hi, could you introduce yourself, please, when you ask the question?
Okay. Hi, my name is Xiu Chuanding. I'm an international student from China. I watched the recent news the Chinese central bank gonna release digital currency electric payment like in the next 2 or 3 months. And I think it's like a very high technology. What do you think of this could be a global trend? And what's the Fed opinion about the digital currency? Do you think the U.S. central bank, like the Fed's gonna release this in the future?
So there's been a lot of chatter about, should the Fed or should central banks issue a digital currency? And it's really complicated in terms of what do you actually mean by that. And I'll give you an example. So I have a PayPal account, and every once in a while I buy something on eBay or I sell something on eBay, and I'll transact in PayPal. Isn't my dollar in my PayPal account a digital currency? It is. So what does a Fed digital currency mean? I guess what people mean by that is instead of having an account at PayPal or Zelle or Venmo, you would have an account, we would all have an account at the Federal Reserve. And that we could all transact with each other, with each of us. There'd be 300 million Americans each having a bank account at the Federal Reserve. I mean, it's theoretically possible. I don't really see what the advantage of that is. So I don't want to say no, never. I don't want to say it's a bad idea. No one has yet made the case to me why each of us having an account at the Federal Reserve is better than each of us having an account at the bank that you already have an account at and can transact with each other. So I think it's something that many of my colleagues are open-minded about and want to look at, and I have a lot more to learn about it.
Back here.
Hi, good afternoon. My name's Natalie Salverson. I work here at UW La Crosse, but my family's also involved in agriculture. So I'm curious to know what your thoughts are on how long the farm economy can continue on its downward trend without that having some broader effects on the rest of the region. Or if you just think that it's going to continue to bifurcate as it's going right now.
It seems like it can go on for a while longer. So farmers have been suffering from low prices for many years now, largely been because of their own productivity. There's been a lot of supply on the global market that's kept ag prices low. Now you have tariffs and trade layering on top of that, so it's like a double whammy. And frankly, I don't see any, unfortunately, I don't see any view that prices are going to go up in a few years from now. I mean, it could be that the global economy and supply and demand could change, but it seems like this is the normal environment that we're in now for the foreseeable future. So you are seeing more consolidation in the ag sector. Smaller farmers that are more financially on the edge are throwing in the towel and saying it's just not worth it, and they're having to sell out. The one piece of good news in all of this is that generally speaking, farmland prices have not budged. They've actually been very, very strong. So that's good for the banking sector that lends to them because that's the collateral for those banks. But it also indicates that other buyers are stepping in to buy up the land. And so I think it's a very tough adjustment for the individual farmers, the family farmers who are going through it. But I haven't seen any indication that is leading to an overall economic downturn in our economy because other buyers who have stronger balance sheets are stepping in and keeping production up.
I think we had a question down here, but we'll first go to the one back there and then one up here.
Hi, my name is Brad Fisher. I work with Riverbank, and I'm an alumni here. I was just wondering what your biggest takeaway is from the quantitative easing experiment in 2008. And I was also wondering what you think the Fed's biggest tools are in the case of another recession, and if you think the low interest rate environment is here to stay.
So it's a lot in your question. I'm going to try to walk folks through it. When we want to boost the economy, we move short-term interest rates up and down. So if we want to boost the economy, we'll cut short-term interest rates. This is an overnight interest rate that banks lend to each other called federal funds, the federal funds rate. Now, none of us, you and I, none of us care about overnight interest rates. If you go to buy a house, you care about interest rates over the next 10 years or the next 20 years. Or if you go to buy a car, you care about interest rates over the next 5 years. Overnight interest rates don't matter. So why do we move overnight interest rates up and down? We move them up and down because they also have an effect on long-term rates. So if we cut short-term interest rates, that sends a message that interest rates will likely be lower in the future, and that then tends to pull down long-term interest rates, and that makes it cheaper for you to buy a house or buy a car. In the Great Recession, the Federal Reserve cut interest rates, overnight interest rates, to zero, and that had some effect on long rates. And then the question was, okay, are we out of ammunition? And the answer was no. Then the Fed turned to quantitative easing by buying up long-term treasury bonds and mortgage-backed securities to directly drive down those long-term interest rates. So the gentleman's question is, what have I learned from that experience? First thing that I've learned is that people said, this is terrible, it's going to lead to runaway inflation, and it's going to crush the dollar, and they were dead wrong. 10 years later, they were 100% wrong. None of those fears have come to pass. If anything, we've had low inflation instead of high inflation. So that gives me more confidence that if we had to use this tool in the future, I think we could use it with more confidence than we had 10 years ago when it was first introduced and when it was new. And then to your second question, if there's a downturn, what are we going to do? If there's a downturn, I think traditionally we would move the federal funds rate down back to zero as the first thing, but then we could turn to quantitative easing or something we call forward guidance as another way of affecting long rates to provide more stimulus to the economy. Let me give you 30 seconds on forward guidance, then I'll turn to the next question. So what do I mean by that? Again, if we want to boost the economy, ultimately we want to move long-term rates. So if we tell you we're going to keep short-term rates low for a number of years, that kind of a commitment will actually have an effect on long-term rates. If we said we're going to keep overnight rates at zero for the next 10 years, then the 10-year rate would be pretty close to zero at that point if our commitment was credible. So this is what we mean by forward guidance. If we tell you what rates are going to be in the future, that actually is another way of providing a boost to the economy. So if we had a downturn, I think we could turn to quantitative easing and we could turn to forward guidance as tools to provide more stimulus. Sorry, long answer to your question, but there was a lot there.
Good.
Getting back to the digital currency.
Can you tell us about who you are?
Tim Shatterberg with Associated Bank.
Thanks.
Getting back to the digital currency, it's one thing to have like Zelle or a PayPal, but you have the other blockchain like Bitcoin. The problem with Bitcoin is it goes against the U.S. Patriot Act. You can't track it. So how would the Fed how would they handle something like that? Because I've heard people say, well, when we can start accepting Bitcoin to pay our taxes, it's going to become, a given currency. But how, if it's going to be blocked?
So I'm deeply skeptical of these cryptocurrencies, Bitcoin and all these others. There's thousands of these garbage coins that have been created out there, thousands of them. And why does the dollar or the euro or the yen, why do we trust it? We trust it because the government has a monopoly on who's allowed to create it. If you literally, if you went home and started photocopying your dollar bills on a color laser printer, the Secret Service would come knock on your door and put you in jail. You're not allowed to do that. So that scarcity, the monopoly right of the government to create currency, is what makes it valuable. The challenge with Bitcoin and all of these other coins, there's no barrier to entry. You can go home today and invent your own version of Bitcoin, and you call it something else. Call it Neel Coin, call it TJ Coin, but because there's thousands of these and there's no way to tell them apart, it's just chaos. And so I've become deeply skeptical that this stuff has any value, any merit anywhere, just because there's no barrier to entry of somebody else coming along and creating another version of it. So whether it's legal based on the Patriot Act, I don't know, but I think there are much more fundamental flaws. And usually when I speak to college campuses, a lot of college students are interested, they want to ask about it, and I always ask them a question. Has anybody in the audience actually bought something, a physical good, a book, a pack of gum, anything, with Bitcoin? Anybody want to raise their hand? So I don't see, we've got hundreds of college students. Not one person has actually bought something with Bitcoin.
Well, it might be drugs, and they don't want to raise their hand.
Well, hey, at least that'd be something, right? I almost never meet anybody who's actually bought something with Bitcoin. So until anybody can transact with it for something other than illegal activities, I just think it's more of a novelty. It's Silicon Valley's version of a Pez dispenser.
Hi, I'm Joe Gow, and I have the privilege of serving as the chancellor here at the university. And I know, wow, this is an incredible turnout. So thank you so much for coming to spend time on our campus. My question is about higher education, and you noted that in the Great Recession, birth rates declined and they have not recovered. And demographers have told us that, in a few years, there will be far fewer high school graduates in this region. Our campus is very traditional, primarily 18 to 24-year-old students, many of whom want to live on campus. We do some things online, but the sort of core activity is the classroom. What do you see as the future for a university like ours, given the demographic changes that are coming?
Well, this is a challenge all over the country. Especially in rural communities, you're seeing young people go away to college. So the communities that your young people come here from are also concerned because their own local communities their populations are declining. So this is a big challenge. And economic growth comes from a couple things. It comes from productivity growth, which is we invent new technologies and we're smarter, we get better education, and it comes from population growth. And the fact of the matter is, our population is growing more slowly, simply because we're having fewer kids. So it's true, what you're going to experience at the university is one example of many of how this is going to affect our society. So we have three choices. We can either accept slower growth, which means fewer students on your campus, which means fewer programs, fewer faculty, less workers. We can accept slower growth as option number one. Option number two is we can try to subsidize fertility, where you have the government giving, everyone laughs when I say that, but you get the math, right? The government could give you tax credits for every child that you have to try to encourage more fertility. It takes 20 years to grow a new worker, so it's not a fast solution. Or number three, you can embrace immigration. That's it. That's the math. I'm not going to offer you a moral judgment on those three choices. I'm just here to do the math for you. That's it. Now, historically, immigration has been a big source of economic growth for our country. And Japan is facing the exact same challenges, but to a much greater degree than we are. But culturally, Japan is very resistant to immigration. So they literally are trying to subsidize fertility with Japanese families. It doesn't work very well. So to me, I think immigration, having a smart immigration policy for the country makes a lot of sense and could keep our towns vibrant and our universities vibrant and our workforce vibrant. But that's a political choice that we have to decide as a country.
I love my kids, but you couldn't pay me enough to have a third. No way in the world. Back here.
Hi, my name's Jake Thomas, and I'm a finance student here. My question is sort of about if a recession is coming and you cut rates to zero, what if that doesn't work? Do you think you would have to use negative rates? Because I know some foreign governments have been kind of experimenting with that, and how would that affect our current economy?
So I think, would we use negative rates in a recession? I don't want to say no, never, but it would be one of the last tools that we'd want to use. So as I mentioned to the gentleman earlier, if there were a downturn, I would expect that we would cut interest rates back down to zero is the first thing we'd do. Then we would turn to forward guidance by making commitments on keeping rates low for the foreseeable future. We'd turn to quantitative easing as another tool. But if there was a downturn, so 10-year Treasury yields are very low today. I don't know where they are, 175, 180, somewhere in there. And in Europe, they're roughly at zero. So if there were a downturn, it's not impossible to envision the 10-year US Treasury also being at zero, given they are in many advanced economies. If the 10-year Treasury were at zero, I could see an argument that we might want to have some positive slope in our yield curve, which would then say that would be a reason why to lower the federal funds rate to negative territory. It's not something I'm predicting. It's not something I think is likely, and it's not something I would frankly want to do, but I don't want to absolutely rule it out, saying it's impossible if economic conditions justified it.
Can I follow up on the forward guidance issue? So, this is something that the Fed sort of toyed with to start with, and it's dipped its toes in the water and has sort of continued to ratchet up. So can you describe the changes that you've seen over your time at the Fed in how forward guidance is developed, and then sort of the different types of forward guidance you might think about, whether it just be interest rates or whether you might announce a target, nominal GDP or wage growth or something like that?
Sure. It's very complicated. So forward guidance, whenever we speak, so I'm one of 17 participants in the Federal Open Market Committee, and we have our chairman who's one of the 17, and when he speaks, and obviously he moves markets because he's the chairman of the committee and he leads the committee. Whenever we speak, whether we like it or not, we're giving a view into the future. So in December of last year, the Federal Reserve raised interest rates, and we indicated that we would likely have more interest rate increases to come. And then the bond market freaked out, the stock market freaked out, businesses freaked out, and then by January, we changed our tune and said, okay, maybe we're going to be on hold for a while. And we didn't start cutting rates until July. So the policy, the official policy did not change between December and July. Just our language changed. Just those language changes led to a rebound in the housing market. Because we changed what we were saying about the future, long-term rates fell, and that led to more people buying homes and more people building homes, and home starts picked up. So that's an example of forward guidance can be very powerful in its effect in the economy, whether it's intended to be forward guidance or not. And now if you go further and you say, well, now we're going to tell you this is what we're going to do to provide more stimulus, I actually think it could be very, very powerful if we want to use it that way.
Excellent. It's another question. Yep.
My name's Christina Gertis. I'm the Director of Contracting and Payer Relations for Mayo Clinic. And one of the things that I certainly hear from local employers is that the number 2 item line on their budgets is healthcare costs. Given the demographic changes and the increases in Medicare-aged patients, the expansion of Medicaid in many communities, and now the partial privatization of veterans, and the government payer mix that healthcare organizations, particularly the more rural you get, are facing, how is that going to affect our overall economy in the long run? I mean, it's going to, what it does from a healthcare perspective is every time we add government payment sources that don't cover costs get shifted to private insurances. And it's like a hidden tax to our employers. And the non-modernization of government payer sources and the fact that they don't keep up with inflation rates certainly has affected our employers and our communities. And I'm wondering, from an economic standpoint, what kind of change has to happen to make that work?
Well, it's a very complicated question, and I don't have all the answers to it. Part of what you got at is the mix of who's paying, whether it's government or private employers that are paying. So that's a very important issue that you raise. And another really important issue is just the percentage of our economy that is going to healthcare. And as society continues to age, I would expect that that's just going to increase over time. Just not, regardless of who's paying for it, it's just going to become a bigger and bigger share of our economy because we're getting older and we need more and we expect more and better healthcare coverage. These are big, I don't mean political, they are political. I don't mean political and partisan political questions. These are big questions that we have to face as a society of where we want to prioritize, whether it's investing in young people with early education, it's spending on defense, it's spending on healthcare. We all have wish lists that are much longer and much bigger than we actually can afford. So as a country, we have to just have honest conversations about where are our priorities, how much do we want to spend on healthcare versus other priorities. I wish I had a better answer for you than that. I don't, because I think each of us in this room would have our own wish list of what we think is important, and they would all be different. And somehow we have to use our political system to try to come together and make these decisions. So I'm sorry I don't have a better answer for you than that, but it's a complicated but important question.
We have a question in the back.
Hi, Kyle Cable. I'm a finance major here at UWL. 2 questions kind of dealing with the housing market as you've kind of talked about. How would you, or some thoughts on combating a housing shortage here in La Crosse? And then also off of that, being a young investor that hopefully, graduating here soon, how would you go about investing in the real estate in this area with a lot of people saying that this market's kind of been saturated? Thank you.
Well, all right. Your 2 questions are completely contradictory. You said there's a housing shortage, and yet real estate in La Crosse is completely saturated. Don't invest here. How can those both be true?
Well, I'm just thinking as if, because a lot of people say invest in real estate in where you live. That's where you should start. And so my question is based off of there being a shortage. I'm saying that a lot of people are in the market already and have all these housing, especially 360 Realty. So if I'm somebody who's going to has lived here my whole life and wants to start investing here, what would be your thoughts on trying to impact and penetrate the market when there's a lot of bigger players that are already playing in there?
Well, I would say I don't know enough about the La Crosse real estate market, first of all, to give you specific advice. I don't want to give you bad advice. And number 2, I'm not allowed to give investment advice. So both of those things are working against me, providing you a good answer to your question.
Can I jump in to clarify his question a little bit? So I think what he means is, so there is a housing shortage, which means big returns for rental companies. and there are lots of big rental companies that make a lot of money, and as a small sort of student investor, he can't overpay for a property like some other people do. So the supply of properties available to purchase as an investor are kind of limited. That is part of the reason why rental rates are so high.
So I guess, what I would need to understand is, and this is a common question or a common topic around our region, what are the barriers to new people coming into building apartment buildings and building homes? And why aren't, if there are good returns to be had, why aren't developers coming in to take advantage of that opportunity? One thing that I hear everywhere that I go is regulations and regulations and regulations keep getting added, which is raising the minimum cost of a house. I'll give you an example, an extreme example. In California, they passed a law mandating roughly $10,000 of solar panels on every new home. Whether you like it or not, whether you think that's good for the environment, that is a direct impact on affordability for working families. And every time somebody has a good idea like that, it gets layered on top, layered on top, and layered on top, and it keeps driving up the minimum cost of a house that directly affects affordability for working families. So I don't know enough about the La Crosse real estate market to understand why more supply isn't coming in. TJ, maybe you know, but that would be some place to start.
Yeah, I mean, I think it's really sort of localized. One, we have been adding a lot of supply, but for the students, they want to live in a 2-block radius of campus. So that really is constrained by the property there. And you've seen landlords tear them down and build new units. So it is happening. But it's still, being a landlord in town is a license to print money, I think. I mean, not a legal one. But other questions?
I'm Jack, and I'm an accounting finance student. There was a question earlier about negative interest rates. The European Union does have that currently, and I just want to figure what have you guys learned, especially looking at the European Union, and why is negative interest rates so low on possible tools that the Federal Reserve could use in recession? Thanks.
I think we've learned that, first of all, the U.S. economy is more competitive and stronger and growing faster than Europe, and that's good news. But I think we are paying attention to what central banks around the world are doing. And partly, we have to really understand what problem we're solving. Are we trying to use monetary policy to solve a demographics problem? Like in Japan, Japan's economy on a per worker basis is growing just as fast as America. But because their working age population is shrinking, they fundamentally have a demographics problem. And I don't think monetary policy is a good solution to a demographics problem. So we are paying attention around the world. What are the effects? I don't think negative rates have caused terrible consequences for Europe. That's why they continue them, and they've gone further. But we also look at our economy is different. Our financial system is different. We have big money market industries, et cetera. I think the nervousness here is that the way our financial system is designed, the way it's evolved, it may not be as effective in America as it is in some other countries. So that's why I don't want to say no, never, but I think most of my colleagues feel like this is not something that we would reach for early in a downturn.
Well, before I turn to the next, I want to, since you're here, pick your brain on sort of what you see how you see the economy evolving. So Janet Yellen and Ben Bernanke are famous for saying that that recessions don't die of old age, the Fed kills them. And so
did they say the Fed killed them?
They said the Fed has killed every one of them. Yeah, pretty much.
I see. Okay.
And that might be a loose
loose
translation, but basically that's what Ben Bernanke said. But you've worked very hard to prevent the Fed from killing this current one. But what do you see as potential threats to the life of this long growth period?
So you are right. I mean, monetary policy can kill an expansion, and I'm really happy that we've cut rates now 3 times. I think that's much better than where we were last year. Other threats are tariffs and trade. So, we can model, our economists at the Fed they've got computer simulations of the U.S. economy. And if tariffs go up by 10%, we can quantify that. We know how much the economy that represents, and we can estimate what the overall effect's going to be. That's not the dangerous part. The dangerous part is when you have these trade wars and it shocks confidence. If businesses all of a sudden get really nervous about the future and say, you know what, I don't know if I want to invest in this new factory. I don't know if I want to hire these additional people because I'm nervous about the future. If a lot of businesses do that at the same time, that itself, that scare, that can be enough to cause a recession if everybody pulls back at the same time. This is the part that's so hard for us to estimate that. So we can do the math on a tariff, but we can't do the math on the shock to psychology if it leads to this group fear. So that's an example of something that could lead to a recession. We're not forecasting it, but it certainly is possible. Or if, for example, Brexit, the UK leaving the European Union, if that were to happen in a very disorderly manner, it's these, we call them nonlinearities, these big discontinuous events that take place that we can't really estimate, and then it spirals because it freaks people out. So, or if China had a hard landing, these are scenarios that could cause a recession in America that would be hard for us to deal with because you just can't see it coming.
Okay, Chris Hardy, Seven Rivers Alliance. So the Fed sometimes gets criticized by politicians because of the work that you do, but let's flip the table on that. The deficit spending that's occurring at the federal level is getting momentous. Is there a concern when that kind of spending will come back and hurt the economy just because of the incredible government deficits that we're running up?
So it's kind of a conundrum because right now, you're right, deficits are very high relative to most of American history. And yet the US government is borrowing at historically low rates. So investors around the world are saying, despite the fact that we have all of these problems in America, political anxiety, and we're not addressing the deficits, they still are voting with their dollars, their pocketbooks, and saying, we believe in the US political system, we believe in the United States of America. That's why they're willing to lend money to the US government at such cheap rates. So the challenge is, when is that going to end? And I don't know, and nobody knows. And partly it's a relative game, because right now investors are saying we have more confidence in the US economy than we have in Europe, or we have in Japan, or we have in China. But maybe Europe will get its act together. Maybe China will become more competitive. Maybe Japan will. And maybe investors will say, well, heck, I'm going to go invest in Europe, or I'm going to go invest in China. So it's a little bit of a relative measure. And when is that relative position going to change? I don't know. I do know that Japan has twice as much debt to GDP as we have, and their borrowing costs are even lower. So it seems like this can continue for a while. But the dangerous thing is it can continue until it doesn't. And the challenge is when it doesn't, all of a sudden it becomes very, very expensive for us to service our debt. So we somehow have to reach consensus on addressing this while we still have time. Again, the challenge is our political system is much better at dealing with a crisis than it is at preventing one. And that's what's going to be hard for us all. I wish I had a better answer for you.
Vicki.
Vicki Marcus in La Crosse Area Chamber of Commerce. So 2 statements and then a question. First and foremost, I know you're looking for market conditions. We have a thriving retail industry here that, of course, is disrupted by the big talk, Amazon. And so a lot of us are seeing those brick and mortar stores closing because they can't compete with online sales any further. I will say the collection of online sales tax has helped with that. The second piece, I'm going to push on your comment about wages and pain and that correlation. So a lot of the manufacturers, in the welding example, would love to pay a welder $25,000 more, but that impacts their competitiveness, and then you have tariffs that add another factor to that, so that now they have tariffs, they can't increase wages because they have to stay competitive globally. So my point to the theme to all of those is disruption, and how do you guys see disruption happening so that you can determine true market conditions?
Thanks for your comment and your question. You're right, it is disruption. And disruption is the norm in our market economy. And disruption is very difficult for those who are living through the disruption, but it's actually a healthy part of our economic competitive system. You know, when 150 years ago, when people basically all worked on farms, and then they brought automation into farms, a lot of people said, oh my gosh, it's the end of labor. All these people are going to be out of work. Well, the nature of their jobs changed as they moved into cities and moved into factories, and we're now seeing more disruption that's continuing. So I'm with you. I think everything you said makes sense. On the welding example, you're right. Businesses have to compete abroad, but if there's a welding shortage in America, every manufacturer in America should be facing the same pressure. And so at some point, if there really is a need for more welders, prices for welders will go up, and customers will have to pay it. Otherwise, you're right, though, the jobs could go abroad. So these are complicated issues, and we try to look at economic signals to kind of cut through all of it to figure out where the economy is going. But I agree with you, it is complicated.
Related to that, I know that some of the work that's coming out currently in sort of labor economics would be on sort of these large employers as monopsonists, right? And the fact that sort of it seems like if you look at our businesses, they tend to be sort of larger than they used to be in the past. They tend to be older than they used to be in the past. And so that may be some of the causes for the suppression of sort of wage growth. What's sort of the Fed's view and some of the research you've been looking at sort of say about that?
You know, we have economists across the Federal Reserve who are looking at this, and I think it cuts a number of different ways, because on one hand, the economists will say older firms that have a more tenured employee base tend to be more competitive. They tend to pay higher wages rather than lower wages. And that actually could be a reason why the minimum level of unemployment is actually going down. Other people say, no, you've got these big giant firms and they're suppressing wages. So as I've looked at it, and I haven't looked at it enough, it seems like the evidence is mixed on whether or not, I think the changes that you talked about are real and they're happening, but is it net bad for workers or net positive for workers, net bad or positive for the U.S. economy? I don't know that I have a clear view yet.
Okay. What about the sort of decrease in dynamism? We're seeing sort of fewer sort of startups as well. What are your views on that?
I mean, on the surface, it seems very concerning. I mean, a huge source of competitive strength for America is our vibrant entrepreneurial economy and entrepreneurial spirit. You think about this. Most countries would love to have one Facebook or Apple or Google or Microsoft. It'd be their national champion. The United States has almost all of them. I mean, it's remarkable how much more innovative and competitive our economy is than every other economy in the world, which is great. But there are these indicators that are concerning, that the number of startups has been declining, number of small businesses has been declining. And so it's something that warrants us paying a lot of attention to.
We'll come back to big in a second, but we've got a question here.
Hi, Brad Fisher again. I had one more question. The inflation number has been extremely low, but with housing costs increasing and rent costs increasing, and then with the increasing number of the population going to higher education and higher education costs increasing, do you think that inflation number, is the Fed considering tweaking the weighting on that, or do you think it accurately depicts the costs that the population's facing?
So we don't, thanks for your question. We look at a bunch of different measures of inflation. We don't create the inflation number ourselves. There are independent government economists who do this, whose job is to go out and look at what a typical American family spends in a month, what kinds of things they buy, whether it's food, gas for their car, the car itself, education, clothing, and then they create this basket of goods that is the best of their ability meant to represent what a typical family faces. And, it's not perfect, but they're always looking for ways of making it better and trying to get the most accurate picture we can. So I think it's pretty good. The fact that we have low inflation in America, some of these trends tend to be global. Inflation tends to be global. There's low inflation in America. There's low inflation in Europe. There's low inflation in Japan. I mean, are all of us mismeasuring it? And are all of us mismeasuring it the exact same way? I think probably not. Productivity also tends to be global. If you invent some new technology here, you can export it around the world, and the world can benefit from it. Productivity also seems to be low relative to history all around the world. So a bunch of these things we look at from a lot of different ways gives us some comfort that we're not misreading it, that inflation certainly is not taking off that would warrant a different policy response. Is it really 1.7 or 1.6 or 1.8? We could debate. But is it really 5 instead of 1.8? I don't think so.
So there's a lot of bankers in the audience, particularly community bankers, so I don't want you to miss an opportunity to bash big banks. So I know you've sort of, after the experience of the Great Recession, you've talked about sort of large banks being undercapitalized. What's the Fed doing sort of regionally to think about sort of too big to fail?
Well, the Minneapolis Fed has worked on the issue of too big to fail for many, many years. And when I first came here after my experience at Treasury during the financial crisis, I wanted to double down on that research and update it and say, have we done enough as a country to deal with the problems that arose in 2008? And the answer is no. The biggest banks in America are still too big to fail. They don't have enough capital to protect themselves if there were another downturn, and taxpayers would be on the hook once again. What's perverse about this is that small banks in America today, generally speaking, have a lot more capital, a lot more of their own skin in the game than big banks. But small banks are not risky for the economy. If a small bank fails, it's bad news for that community, but it's not going to bring down the U.S. economy versus $1 trillion bank in America that could bring down the economy. So it's literally the reverse of the way it should be. So we've been advocating as loudly as we can that the biggest banks need more capital, tougher capital requirements. Unfortunately, right now, the political winds in Washington are blowing in a deregulatory way rather than more regulation. You know, we're doing our part to try to push back against that, but, you know, we're one voice.
We have time for one or two more questions.
Way in the back.
Hi, I'm John Kavari with the Political Science Department. There's been some political pressure put on the Fed to lower rates a little bit more than what's happened already this year. I'm wondering if you could maybe articulate the dangers that might be inherent with cutting rates too low, and then perhaps more broadly, just touch on why it's important that the Fed remain independent. Why not let Congress and or the president set rates?
Thanks for your question. So historically, central banks in prior generations had been compromised at times. So in the 1970s, we had very, very high inflation, which really led to bad economic outcomes for workers and for businesses. The reason we had such high inflation is the Fed screwed up. The Fed basically caved to political pressure to keep rates lower than was justified by the economic fundamentals. So then people woke up and said, okay, we got to do better. The way we do better is let's keep the Fed's monetary policy decisions out of the hands of politicians, keep them in the hands of technical experts, kind of isolated from politics to do what's right for the U.S. economy over the long term. And both parties have embraced that, and I think that has really served the country very, very well. So the danger is if the Fed were to do things not based on economic fundamentals, but based on political considerations, that we would keep rates too low, and inflation would be allowed to take off. And then if inflation takes off, what happens is people's expectations about the future of inflation, we call it unanchored, they start to climb, and then it becomes a self-fulfilling prophecy. And then to catch up and bottle that up again, the Fed would have to raise rates very, very dramatically, maybe causing a deep recession to bring inflation back down. So we're much better off, and I think most countries have figured this out, much better off keeping the central bank independent from politics, focus on the economic fundamentals, do what's right for the goals that Congress has assigned us. The good news is people across the Federal Reserve, starting with our chairman all the way across it, really believe in that independence, believe in making decisions for economic reasons, not for political reasons, and all of us are going to do our very best to deliver on that promise.
Excellent. One last question.
I'm Rodrigo de la Pena. I'm a finance and economics student. So there's been a lot of publicity about Elizabeth Warren's wealth tax, with the wealth gap being the largest it's ever been. Has the Fed considered any ways to address that? And in your opinion, do you think Elizabeth Warren's way is the correct way to address the problem?
Well, so, you know, the political independence I just talked about. So we get the benefit of political independence, but our responsibility then is not to weigh in on these kind of proposals. Our responsibility is, you know, if Congress passes a law, whoever the president is, then we'll analyze it and we'll try to figure out what it means for the U.S. economy and what we need to do. What does that mean for the course of monetary policy? So a big fiscal plan, for example, tariffs. We've talked about tariffs. Tariffs are having an effect on the U.S. economy. We then try to estimate what does that mean for the U.S. economy, and then what do we need to do to try to achieve the goals that we've set. We would respond to any of these fiscal plans that the presidential candidates are putting forward, try to analyze what they mean for the economy. But the deal is, you know, politicians will say, okay, Fed, we'll leave you independent. And then the other side of that coin is we'll leave those kind of discussions to the politicians. So I'm going to respectfully decline to answer your question.
That was much nicer than what he did to Joe Kernan the other day on CNBC. He said, come on, I'm not answering that.
That's true.
So I'm going to ask one last question,
Okay.
sort of get an idea of what measures you're looking at sort of going forward. So wage growth, employment to prime age population, like demographically adjusted. What are you sort of really going to look forward to over the next 6 months to a year to sort of think about where rates should go?
Well, you know, we have maximum employment is one of our goals. What does maximum employment mean? It means a labor market that is consistent with 2% inflation. And to go from people having jobs, there's a couple bridges. One bridge is how many people have jobs. Then what does that mean for wages, wage growth? And then you go from wage growth and what does that mean for inflation? So we've got two long bridges that we're trying to cross. We've basically concluded that we don't know how to take the unemployment rate, and we don't know which unemployment rate is full employment. So to me, I think we should focus on wage growth. at least skip one of the bridges. The bridge from wage growth to inflation should be a shorter span than going all the way from the unemployment rate. So I'm very focused on wage growth. Until we see wage growth, 3.5%, high threes, which if you then net of productivity get back to our 2% inflation, how fast should wages grow? They should roughly grow with inflation. Our goal is 2% plus productivity growth, ballpark. Right now, wages are growing slower than inflation plus productivity, which means then that we're not yet at maximum employment. So I'm very focused on what's happening to wage growth. All the businesses saying they cannot find workers, I will believe it when it shows up in the wage growth. And when it shows up in the wage growth, then I'll say, okay, we might really be at maximum employment.
I think that's a great spot to end. Thank you very much for your time. Everybody join me in thanking Neel.
Thank you very much. Really appreciate it. Great turnout.
Have a good afternoon.
Thank you.